How'd you like that opening, Mitch? You know a few people in those
I
pictures.
gotta tell you something, man. That's very impressive. I'm glad to be here. I'm
I'm
surprised
glad.
you invited me, having seen all of those very important people there.
Well, I already called Clayton Collins the man of the hour last week, so I'm going to give you runner-up man of the hour status. Is that okay?
Does it have to be the hour? How about the man of the day or week or month or something at least?
That's a great question.
Yeah,
You're in the kitty now for man of the year. Okay,
there you go. I
is
like
that
that.
good? Have you
Call,
officially been entered?
call up Time Magazine. I'm with you. That'd be great.
All right. Well, your title is the chairman and managing partner of Wiener, Brodsky, and Kiter. So you've been in this business for a long, long time. I believe 4 decades. And still humming along. You once made your home, I think, up in this northeastern corridor, and now you spend a lot of time in the southeast. But you're traveling all the time. You're getting on a plane tonight to go to the National Mortgage News Conference, DIGMO, run in part by my good friend Heidi Padalano. She's fabulous, and of course Julian Hebron is heavily involved in that. So we wish you well there, and hope it's a great conference. Why would you be the man of the hour? Well, because as usual, we're in the throes of lots of questions when it comes to policy, and some things are closer to the forefront, some things are farther behind. I'd like to start talking about the states, if we can, because we heard the rumblings. Hey, if the CFPB is neutered or rolled back, watch out. Be careful what you wish for, because the states are going to step up enforcement. And that's exactly what we're seeing. We're seeing it here at NFM, particularly focused on marketing. There's some efforts to look into LO comp, and there's no one flavor to this. It's all over the board. What can you tell us about what you're seeing out there and what the dangers are to the mortgage community?
Well, let me just start by saying what I'm seeing out there, I expected to see, in all honesty. When the CFPB takes a rollback, when the feds take a rollback, the states lose a friend, and they feel they have to step in. And so you got state AGs, you got state banking departments, and they all think they need to protect their own consumers. So that's what they do. We're seeing exactly what you said. We're seeing enforcement. Well, let's start with examinations. We're seeing examinations, and then we're seeing enforcement on a variety of different topics. You're seeing, UDAP enforcement because states have their own unfair and deceptive acts and practices statutes. You're seeing it along those particular lines. You're seeing fair lending, where you're not seeing it on a federal level. You're seeing fair lending and fair housing enforcement quite a bit from states, and in fact, states have been pretty aggressive in setting up their own standards for that type of enforcement action as well. You're seeing a lot of states that are looking hard, as you said, at deceptive marketing, deceptive advertising, things along those particular lines. And you're seeing a big emphasis actually on what states would call junk fees. I call them earned fees. They call them junk fees. Go figure.
What about junk fees, earned fees? What should we be looking out for, and what are some examples?
Well, there's a fair amount that we should be looking out for in terms of the so-called junk fees. In January of this year, the CFPB, on their way out the door, issued a report to the states. And their report to the states told the states, we want you guys to carry the mantle on a going forward basis because we know there's a new administration that's coming in and it is not going to do the same things that they were doing. And one of the things that they highlighted there were junk fees. So, what about junk fees? I mean, all kinds of things in the servicing arena. Okay. So, if you're talking servicing, you're talking about convenience fees, pay to pay fees. You have states that are going after those things. You have states that are looking at late fees, then matching it up to the contract, see whether or not you can, and state law to see whether or not you can charge those late fees. You're looking at those monthly property inspection fees. You're looking at foreclosure related fees. You're looking at lender placed insurance. You're looking at lenders that, because of a glitch in the system, may continue for a month or two to collect PMI, private mortgage insurance, even though they hit the cap and they shouldn't be collecting it anymore. But actually equally as interesting, or maybe even more interesting to me, is junk fees, weren't really applied on the origination side itself, but now you're seeing it. So I got a number of state examinations in a couple of different states where they're looking at bundled credit report fees. Now, they haven't done anything about that yet, but that's something to take a good hard look at. And that gives me a great deal of concern because the credit report fees that, and the issues that we have in this industry. It's terrible for the consumer. It's terrible for the lender. The consumer is paying a lot of money on credit report fees. The lender is losing a lot of money on credit report fees, in all honesty. And, bundling has provided, somewhat of an answer to some of these problems, although not completely an answer. Unless you get away from the tri-merge reports, you're not going to have a competitive environment in which you're working in. But now I got states that are taking a look at bundled fees.
Can
Okay.
can you elaborate on that? I mean, I think I know what it means from my lens, but this is a very important topic you're bringing up.
Yeah, it's a really important topic, to tell you the truth. And so, what you're talking about is you have your credit report, but you're going to run additional reports. You're going to update that particular report. You're going to do other things. You're granting the consumer, uh, when you're granting access to that credit report for other uses and things along those particular lines. And so what's being offered in the marketplace and what many lenders are utilizing today is a bundled set amount, a fee of X amount of dollars, let's say $100 or $110 or something else that covers all of your credit report needs for the transaction itself. Okay. And that's what's otherwise being bundled together and charged to the consumer. And the states are taking a look at this and they're saying, wait a minute, a lot of consumers aren't getting the benefit of that full $100 or $110 or whatever it is that's otherwise being charged, right? You've got, an authorization to share, you got, other fees along those particular lines, additional screenings, scans of reports to see if there may be areas that may be really problematic about this particular consumer, and you got real-time updates. But for some reason, these states are starting to indicate, well, we don't like the way you're passing those fees through.
All
Some
right,
of
so
those,
let's talk about how that because that's bundled fees are presented by the CRAs.
yeah.
So, and that's a whole nother conversation. The CRAs. So why are they even necessary? I've talked about this so many times. I don't know if you have an opinion about that, but if you do, hold it for a second. The CRAs. I mean, this sort of reminds me of subprime a little bit, right? We the originators got blamed, but we were selling what the subprime folks told us to sell. This was the menu, right? Order what you'd like off the menu, that you're in this place. Isn't it the same thing, or is that a cop out? Like, are lenders ultimately going to be responsible for something regulators don't like that the CRAs delivered to us?
So the answer to your question is it's somewhat of the same thing, not completely, in all honesty. But listen, we're the front lines. Lenders are the front lines here, and you're low hanging fruit, easy to pick off. And when we talk about state regulators, okay, you are the regulated entity to these state regulators, right? And so, sure, they're looking at what you're charging. They don't care if you eat the fee. They don't care if if as long as you don't pass that fee on, but they're looking at those particular fees, and it might be a product that's offered by the CRAs. Obviously, these are offered by the CRAs. They're the ones that are pushing bundled fees, but that's irrelevant. You're the ones that we lenders are the ones that are buying them, and we're passing these things through.
So when you say that's being looked at, I mean, is this something you've just recently started to see and hear about since the new administration took over,
Yes.
or does it have velocity that's different than before?
Well, both. I mean,
Okay.
looked at by states today.
All right. Do you have
Right?
an opinion about
I-
CRAs, Mitch? Do you want to comment on CRAs and their place in the market? I mean, we have FICO, they've got their price, and then they pass it along to the three bureaus, and then they mark that up, and then they pass it along to the CRAs who mark it up because apparently we need three people with their hands in the cookie jar. One's not enough.
Yeah,
I mean,
no.
I think it's horseshit personally. I mean, I don't understand why we need the CRAs, and but what's your opinion?
So, Horseshit, unfortunately, is not in Black's Law Dictionary. It should be there, but for whatever term they use for it, I don't necessarily disagree with you.
All right,
Okay, I
cool.
mean they're effectively middlemen that are marking up costs, and I mean, if I'm a regulator and I want to look at how to hold down costs, and this new administration in Washington, they're about to start their big push for affordable housing and for lower closing costs and things along those particular lines. This is a prime area to look. This is the right area to go look at. Yeah, I think in large measure, what's happening out there is wrong and unnecessary, and consumers are ultimately bearing the price for it, but so are lenders.
No,
Yeah,
there's going to be a day of reckoning, though, for sure. I mean, something's going to happen. And maybe Vantage Score is the answer, although it's still not clear as to whether or not that's going to offer a savings, or it could potentially double the cost, right? Imagine if agencies, Fannie and Freddie, say, all right, we'll take them both now. We need 3 from each. I don't think that's going to happen. More likely to be a buy merge or whatever, but it's still possible. We don't have clarity on that. So when you talk about a day of reckoning, like if bundles aren't
yeah,
available and and this is reconstructed in some way, like credit is a very it's expensive, and the consumer, the biggest injustice, and I love your comment on this, is this idea, for all the things that Director Chopra maybe didn't do right. One thing that he had talked about that had the NBA support, at least it seemed like, was this idea of consumers owning their own data, where, hey, look, I'm gonna buy my credit report, and then I'm gonna authorize these various lending institutions to view it, and it'll be good for a certain period of time. Whereas now, you want to talk to lender A, they'll pull it. You want to talk to lender B, they'll pull it. You want to talk to lender C, lender C, they're going to pull it, right? I like this idea of a consumer repurposing their credit and owning that file. Any thoughts
yeah.
on that?
No, I think that's absolutely right. I like the idea. It looked like it looked like the industry was basically saying, okay, this makes some sense. It was bothersome at first because they didn't know what all the consequences or implications of that would otherwise be. But yeah, I mean, it's cost savings at the end of the day. It takes out inefficiencies, in all honesty, and it's not necessary to go from one place to another and continuously order these. The same credit reports themselves. Although the credit does need to be updated before you before you go ahead and close. It's kind of important. But let's go back to the Vantage Score, issue that you said. So I know Vantage Score. I like Vantage Score. I know Barrett Burns. I've known him for a very long time. I think he's done a great job putting that together, and God knows he's been fighting for a long time to get the GSEs to.
He is also a former guest on One on One, just so you know. He was on about
That's great.
6 episodes ago.
No, that's great. That's great. I think he's created a good thing, and I think in the long term, in the long run, what Vantage Score does is going to open the door for many more people to be able to obtain housing by utilizing alternative credit such as rent, utilities, payments, and things along those particular lines. But I will tell you, in the short term, don't expect that the consumer is going to be paying less, and don't expect that you're not going to get hit up with a lot, because no one really knows, what's happening. So the GSEs are only going to require you give them one score, right? But the bondholders are going to think, okay, you're cherry picking. Of course, you're going to give them the best score, So what's the other score that's over there, right? And they're going to want to know. And it's going to be expensive. It's going to be duplicative to a certain extent. It's going to be expensive because they're going to price it, for a tougher score. That's what they're going to do. They're not simply just going to go ahead and say, oh, yeah, this makes a lot of sense. They're going to price it for what's unknown. They're going to price that loan for what is unknown. You follow what I'm saying?
Yeah, of course. Yeah. But it gets more complicated because Vantage Score, the plot thickens. Vantage Score is owned by the 3 bureaus.
Right.
It's like, I mean, it is the most tangled web we weave of all time. I mean, it's such a racket. Any comments on the trigger legislation that passed and the carve out for servicers and loan originators, and also banks? I'm not sure if you want to comment in this space, or how it how it impacts you, if at all. But for me, it took this idea of an even playing field and skewed it very much in the favor of the servicers, who I understand are the most important link in the chain. Like if the servicers can't get value and can't depend on that value, well, look, we all depend on them. I mean, they are the lifeblood of the industry. In fact, they saved many companies after all the margin calls and after COVID, and when it got tougher out there and companies need to recapitalize, they were there. They were there for all of us. They were there for NFM. So you don't want to bite the hand that feeds you, but I think they got the trigger thing wrong. I mean, the original legislation didn't have a carve out, and that got turned away 3 or 4 times. And then lo and behold, there's this carve out and it passes.
So, I know where you're coming from, especially, being in the position that you're in with your company. But in all honesty, I think what you just said really, hits it right on point. The service is really, really important. The value of that servicing is really important. And having that just picked apart over there is very problematic, I think. So.
But we're in a different time now, Mitch. Just stay with me here for a minute. I know I'm cutting you off. I don't mean to, but
Okay.
you're much smarter than I am. So I can retain and hold on to things
About that.
for much shorter periods of time than you. So here's the thing. We have this concerted effort, which I want your opinion on. You've got Guild and Lakeview teaming up.
Yep.
You have Rocket and Mr. Cooper teaming up. Like they are going for this business right now. I don't think we can assume that there's always going to be this ecosystem where we've got all these IMBs over there feeding the servicing machine. They're churning those people. Like I think they want to get into the retail space. I think they want to. They want to get down to 4 or 5 different servicers that also originate that run this whole thing, and that's a threat, I believe. What do you believe?
That is a threat to many IMBs that are out there. There's no doubt about that. That is a threat to many IMBs that are out there. It's good business from their sense, to tell you the truth. Now, guilds, a number of those companies that you named are good clients of mine, and I do a lot of work. But I take a look at the Guild, Bayview, Lakeview deal, and of course, it makes all the sense in the world. Makes all the sense in the world. Who owns the servicing? Who owns the contact? Who owns the client relationship? How do you keep it? Right? And so it makes sense for services like Lakeview, okay, and Bayview to move into that particular arena. And of course, they want the retail. There's money up in those hills. That's exactly right. So I understand. And is it a threat to the
IMB that doesn't service?
the IMB infrastructure that we have now with many IMBs all over the place? To a certain extent, it is. To a certain extent, I think it is. And I think there's some very large players that are going to try very hard to own the market. We'll see. We'll see how successful everyone is. I mean, you got Rocket and Mr. Cooper. Okay, on paper, it looks great. And you hear a lot of great things about Rocket and Mr. Cooper, and now with Redfin in there. But you never know. You never know how these things are ultimately going to work out.
Well, I'm going to ask you a question I asked Rob Chrisman a couple of weeks ago. I'm not going to tell you what his answer was, okay?
Yeah.
Rocket, through those acquisitions, I think has just beneath 10% of market share. Do you think they'll ever get to 20%?
Do I think that they will get to 20%?
You've been around a while, man. You know that leaderboard has been like a revolving door. Like Countrywide was once going to be the only lender out there.
The answer to your question is, well, I don't really know, but I think it's going to be very difficult. I think it's going to be very difficult.
He said no, by the way. It took him like much less time than you here. I just asked him a question literally before I could finish a word. He said no.
But it'd be very difficult for them to get 20%. To a large degree, what IMBs do is very local in nature. Okay.
That's right.
And I'm not sure that they're going to be able to capture all of those things.
There it is. That's it.
I'll tell you 2 stories about this. That involved me. One was, I did the deal when it was known as Norwest. Okay, before it was Wells Fargo. I did the deal that acquired all of the assets of Prudential. I did that for Norwest. Now Wells Fargo. And when I did that, it was a huge deal, and they were talking the exact same way. And they were going to hit 1 in every 12 mortgage loans in the country was going to be theirs. And the reality is, it didn't really take off beyond, you know, beyond what what it was when they were done doing that. So they didn't take over the world. They grew. They were big. They were large, and then they decided, you know what, we're going to take a step back. We're a bank, and there's too much exposure and everything else that's out there. We don't really understand this mortgage business as well as we otherwise as we otherwise know this mortgage business. So, and there are other situations where where I've seen this happen as well, where I represented Sendent. Do you remember Sendent?
Yeah, I remember the name. Yeah.
Yeah. Well, it came together. It was an online company that had a lot of real estate. It ended up being Realogy. And now I think it's called Anywhere, Anything, or something along those particular lines. But Sendent was a huge company. It was PHH Mortgage was the mortgage part, but it was called Sendent Mortgage. When the two companies came together and formed this conglomerate, it was amazing. Every major real estate house, in the country was a part, or was owned by Sendent's, and they had their affiliated mortgage company, Sendent Mortgage. Did that ever work at the end of the day? Did that come together the way they had hoped that it would come together? No, not at all. That's why it ultimately got broken apart, right?
So
And
it's a
then
lot easier said than
that's
done,
gone
is
up
your
again.
point. Yeah, that
Hmm?
we've seen a lot of billboards that suggest that market share is going to start getting gobbled up, and up until now, it hasn't been successful. Now, this is a different time, right? I know we always feel like everything is a different time, but technology, AI, this lower cost to produce is the one variable that we haven't faced before, because now not only can the servicers get to the clients when other people can't, but they can also offer a much lower price as they build this bridge to market share. And so what I mean by this, so what's going on, is we're seeing them go deeper and deeper than they ever have, where we might be in the market for a deal where we maybe would have to cut 200 basis points to do a streamline on an FHA loan. They're coming in 400 basis points, where essentially all the profit it has eroded. You can do the loan for free, or you can not do it at all. And technology, lower cost to produce. Now this point where they're able to access the servicing, the trigger leads, and I mean, there's a reason they're paying up more than they've ever paid up. And to me, I feel like they're trying to get to the other side to grow this market share. And I know we can go,
I,
on and on and on about this.
they're certainly trying to get to the other side. We'll see.
Yeah.
We'll see
All
what
right. So I've got a bunch of things for you.
Go ahead.
I'm gonna keep you for at least another 10 minutes. Mortgage fraud, occupancy fraud. Director Pulte has talks about it maybe 5 times a day on his X feed, which I happen to get alerts for, so I'm constantly beeping. Focused on Dr. Lisa Cook and the fact, I guess, or the claim that she's got multiple properties that indicate that their primary residences, when you can only have one primary residence, to my knowledge, one place where you live all year round. When I think about that, and of course, you're a prominent attorney and you spent so much time in the mortgage space, I think to myself, the lender is equally responsible, if not maybe more, for asking the right questions, doing the digging. I mean, I'm not trying to put the onus back on us, but am I off here?
Well, equally responsible in what sense? I mean, ultimately,
Equally responsible for sniffing these things out and not letting that go through. I mean, there are plenty of originators that have known, hey,
that's
look, you're not moving into this house. I see you check the box that it's going to be a primary residence, which gets you better terms, and I'm just going to let that go. That's what I'm talking about.
yeah, no, that's fraud. I mean, occupancy fraud is fraud, and a lender that participates in that and lets that go is committing fraud. There's
Okay.
absolutely
All right, we're on the same page. This idea of a flywheel. Let's go back to Rocket for a minute, where you've got all these ancillary services you're going to try and push people into. You got insurance, you got staging, you got electric bills, you have title. I mean, it goes on and on and on. Like there's anywhere from 10 to 20 spokes in the wheel where they can try and grab a little bit of income. Any danger there from a steering perspective? Do you think that can work? Because they're really relying on this flywheel idea that they can keep everybody in their ecosystem for everything having to do with their finances soup to nuts.
I think it can work with a large segment. Okay, I think it can work with a large segment because there's convenience that's associated with that. And getting a mortgage loan and taking care of everything that you need to take care of has been a messy process for a long time. We have a great finance system in this country, the best that there is, but it's a messy process. And consumers are shopping around, they're going to different places, especially first-time home buyers, they have no idea what to do. So there's a certain attraction to a one shop, fits all, or a flywheel, or however you want to term it. So I think it works. I think it can work, depending on how good their customer service is, depending on the relationship that they have with their customers, and whether or not they can hang on to it. At the end of the day, I think it's going to be an execution play. It's execution that's going to determine whether or not that's going to work.
Okay.
And executed properly, I think it can work. And I
You
do
know,
think that's a threat to many players in the industry. Yeah.
another threat, yet another threat. Um, LO comp, we have to talk about that. Can you believe I waited 26 minutes? If you were a betting man and you before we started said, all right, Greg Sher is going to interview me, and
Yeah.
he's not going to bring up LO comp until the 27th minute, you would have never believed it. So I have accomplished what I set out to accomplish. I heard you recently talking to my very good friend Brian Hale, who I respect immensely. Um, and you told Brian that even if you think something will be done, but at the soonest 18 months, potentially longer, to have something done here. Why so long? And what do you think ultimately will happen with LO Comp?
Because you got to go through notice and comment rulemaking. Nothing can be done by edict. Although the last crew at the CFPB believed otherwise when it came to certain matters. But the reality is, what's going to happen is through the CFPB, this administration is going to issue some type of a preliminary rulemaking. An initial rulemaking. That's what it's going to be. It's not going to have effect. It's out there saying, you guys, public, industry, public, everyone, come tell us what you think. What should we do about this? Here are our ideas. What are yours? And by law, they got to give you a sufficient amount of notice, right? They've got to look at your responses, and there are so many different sides to this particular issue. They've got to take it into account, and then when they issue a final rule, as opposed to that initial rule, when they issue a final rule, they're going to put some time on it until that final rule takes effect. And that's why I tell you it's going to be 18 months.
Got
And
it.
18 months is pretty quick to get that done. What do I think is going to get done at the end of the day? It's interesting because I think that the administration today looks at regulations such as loan originator compensation and says there is too much government involvement in business and too much in industry. And now you're telling us how people can get paid, what you can get paid for what you do. And I think this administration really dislikes that and doesn't want that done. But it's interesting because you've got both consumer groups and you've got lenders that say, wait a minute, okay, don't throw the baby out with the bathwater. Keep what's good, and let's just fix it. And so, what do I think is going to happen at the end of the day? I think you're going to get a proposed rule that purports to throw everything out, and I think they're going to get a lot of comments. And they tend to listen to the industry. This administration does on policy-related issues, which is smart because they're looking for the expertise that exists there. And I think they're going to come back, and I think they're going to make some decent changes to it. I think that it's ridiculous that you have to pay the same amount or on the same basis for an HFA down payment assistance loan that you do for other loans that you're otherwise making. I think it's problematic that your loan originator cannot share in helping making that deal done, and getting that deal done for you. And so I think there are going to be some good changes that come out of it, as long as they get it all done in time.
No,
You know,
the CHLA has proposed. In fact, a group of constituents, along with the CHLA, went to the White House. I was fortunate enough to be in that group last week, so was on the White House property for the first time ever. Met with Mark Calabria, had some conversations with him about this, and so what I've been told and led to believe is that they don't and the argument the CHLA is making, which I think is simplifies it in a way it needs to be simplified, because this thing can get onerous and complicated very fast, is that the government shouldn't be telling an employer how to pay their employees. They just have no. So that's the argument they made. But before we run out of time, I do have two other things I want to ask you about. Quite a few mortgage companies are paying real estate agents now. They're paying them to originate loans. They're paying them as business development associates. And I think we refer back to that December 15th, 2022 letter on FHA letter regarding dual compensation, where it went to, pretty great lengths to point out those who can and can't be dual compensated. And the realtor used to be in that group. They were pulled out. And it seems like ever since we're in this environment now where the coast seems to be clear on paying real estate agents, even if they're not licensed as business development associates, on deals that they do potentially as branch managers, co-branch managers. And some companies are doing it full scale, wide open in daylight. Some companies are doing it more on the DL. As the leading attorney in our industry, what do you have to say about this?
I say that separate and apart from what FHA said, you have other things to worry about. One of them you mentioned, and that's licensing. Okay. And the other thing that you still need to be concerned with is RESPA. And so hiring a real estate agent to be a loan officer, or hiring, more likely what you're seeing out there are, these business development officers, or hiring someone to, be a branch manager or something else along those lines. All of that is going to be subject to a RESPA analysis, right? And you need to have some type of a sham analysis to judge whether or not this is real, appropriate, or not appropriate. Okay, if you're going to hire someone that owns a brokerage, a real estate brokerage, or is part owner of a real estate brokerage, and say, you know what, I want you to be a branch manager in my branch. You better make sure that they're actually doing all the duties and responsibilities of a branch manager. Okay. Because from a RESPA perspective, otherwise you'd be able to pierce right through that and say the only thing you're doing is making payments for referrals that are coming in. It's just referral fees themselves. So the ultimate analysis in this is, if you're going to take a real estate agent, you're going to take a real estate broker, you're going to take anyone along those particular lines, and you're going to give them a job. Did you really give them a job? Or is the only thing they're doing is talking to people and telling their own people to refer business in? And if they're only referring their own business in, you're going to have a problem ultimately on your hands. And if you're not going to have a problem with the federal government today, you might have a problem with them tomorrow. And you are going to have a problem with a number of states that are out there. And the reality is, what I tell clients when they want to do these things, I tell them that's fine. You can go ahead and do it. Make sure you get them licensed, number one. And number two, have a job description and review it, and make sure they're actually doing that job and putting the hours in. And without fail, virtually every time they go back to a real estate agent or a broker and they tell them, here are the things that you're actually going to have to do, they say, forget it. I don't want to do it because that's not my business. My business is either selling or buying homes.
Well, you just made a comment that this will be looked at today. If not today, it will be looked at tomorrow. And that is a perfect segue into my last question about this idea that, change of administration, there's a statute of limitations, that everything in play today will be, even if you're okay, even if there's deregulation and all these other things and a reeled back CFPB, that doesn't mean that a Democratic administration in 3 years or so can't go back and look. Like, you hear that, Mitch, but is there precedence for this? Is that really going to happen? I mean, come on. I mean, they've got their own shit to do. They have their new policies and to get everybody settled in. Are they really going to start going back?
The answer to your question is there is precedent for it, and we just lived it. If you look at least half, probably more than half, of the enforcement actions that were taken by the Biden administration, they were for actions that were committed during the first Trump administration. So they certainly did take a look back along those particular lines. They lived within that statute of limitations. But there are two things going on. I know we have to go, but there are two things.
Well, I'm good. I'm good for another couple of minutes because I forgot to ask you an important question.
No problem. One is enforcement, one is regulation. Okay? If the only thing this administration does is lay back on enforcement, but the laws remain the way they are, and the regulations remain in place the way they are, then yes, there's a risk that in the next administration, someone's going to take a look back within the statute of limitations and say, you have a problem on your hands. But if they really are in a deregulatory mode and they're taking the regulations down, okay, and the law is no longer the law when this new administration comes into play, then no, no one's going to be able to take a look back. So it depends on how far this administration can you know, take what it is they're trying to accomplish. Is it simply going to be laying off on enforcement, or are they going to get Congress to help them out? They can do it themselves from a regulatory perspective, but as I just showed you with LO Comp, that takes time. They better get started if they're going to do that, right? Or are they going to get Congress to help them out in taking down some of these statutes?
Got it. Realtors get paid 1099. We have to pay our LOs W-2. It's my understanding there are certain facets of the mortgage industry. I don't want to name anybody out because people listen to this, whatever, where they're paying originators 1099, certain segment of the business. What's going on here, and is it possible to ever get to a place where loan officers, what's more likely to happen? Realtors one day will be W-2, or loan officers will be able to be 1099 and really run their own businesses within ours?
I think what's more likely going to happen, in all honesty, is one day loan officers are going to be able to be W-9. That's what I think is ultimately going to have 1099. That's what I think ultimately, that's the direction we're headed in. What's going on right now is there are some states that specifically allow you to pay your loan officer, okay, on a 1099 basis. All right. As long as you are acting in accordance with our federal tax laws, with the IRS. Okay, so they have to be able to exercise some judgment on their own and things along those particular lines. As long as they don't carry all the indicia of actually being a full-time employee of yours, even though they are, effectively working as your employee. So there are states that are allowing you to do that. And
how many? Do you know off the top of your head roughly how many states will allow that?
If I had to guess, there's probably a handful of states.
A range, maybe 5 or so. Mitch, is there anything, if the industry wants to get behind this idea, is there anything that we can do to move it up closer to the front of the line to make that happen?
Well, it's not so much a federal issue anymore, to tell you the truth. It's a state issue. And that's where you have to move it up along those particular lines. So FHA, for example, used to say absolutely not, W-2, W-2, W-2. Now what FHA says, it's got to be done in accordance with our employment laws, our tax laws. So it's not so much a federal issue as it is a state issue right now. And sure, I mean, and that's where the work needs to be done. States and licensing bureaus, they need to sign off on this for this to happen.
And that's a one-by-one thing.
That is a one-by-one thing.
Yeah, well, I mean, that sounds like it's not going to happen anytime soon. I know you're feeling on RESPA. I heard you talk about the RESPA in particular, Section 8 kickbacks, anti-kickback revisions. That that 50-year-old rule is probably not going to change anytime soon. So I did get that, and I wanted to pass that along to everyone. We've covered an awful lot of ground, and this has not surprisingly become a video every single C-suite person in our industry should watch. So I will be sharing that, and I understand you're going to be participating in a CHLA web presentation on Wednesday. I'm going to put that in the comments now. On the future of IMBs. You're also going to be at the National Mortgage News DIGMO conference on
tomorrow.
I guess later this week, right? You're flying out tonight here on this Monday. Have I left anything off the table? Any closing thoughts?
No. My only closing thought over here is, we're in an interesting time. We have an administration in place that is looking to change certain things, but we have to stay on top of the issues that are out there.
Yeah.
You put together, Rocket, Mr. Cooper, those types of deals, arrangements. You take a look at what Zillow's doing with, they probably have more data than anyone has, quite frankly, and they've got a different type of business plan in place. I think the industry has to watch closely, see what works, see what doesn't work, and adjust to the times. And that's where
Well, Zillow did 3.5 billion or so in mortgage originations in 2024. I think they want to be as big as anyone, right? It's not that easy to flip that switch, but they have the most important thing, which is the most elusive thing, and that's leads.
That's exactly right. And I think they can be as big as anyone if they execute on their business plan.
Time to go out and buy some Zillow stock. You know, if you had bought Loan Depot stock 2 months ago, you'd be 5 times richer with that money.
Yeah.
Another problem in our industry is rising insurance costs. And next Monday, I will speak to David Snyder, who's the Vice President of International Policy for the Property Casualty Insurers Association of America. That will be very interesting. Mitch, I hope that I've lived up to your expectations. We'll make sure that my producer puts you up in that montage.
There you go.
So you're now a part of this, and it's always a pleasure. I enjoy the time that we've spent getting to know each other. We don't talk as often as we had first planned. We had a nice breakfast together. I think you may have even paid, and I think it's been about 8 months since then. So we got to get together again.
All right, man. I'm here for you anytime.
Right. Have a great trip.
Be with you.
Time. All right, Mitch Kiter, so long. Greg Sher saying so long to you. Have a great week, everyone. Appreciate you joining us for One-on-One.
Bye-bye.